Well, a rising number of financial experts say that the U.S. is headed into a recession as inflation continues to soar. In the first quarter of 2022, the U.S. GDP dropped by 1.6%. Technically, the country is in a recession when gross domestic product falls during 2 quarters back to back. So here to talk a little bit more about this is Javier David. He is a managing editor and business and markets for business and markets at Axios. Is it David or Davis?
David.
David, okay. I wasn't sure if I got that right. Okay, so let's talk about this because I thought to myself, you know, people are already fearful that a recession is coming. And if you are fearful, you are less likely to take economic risks. Maybe you'll fix that refrigerator instead of buying the new fancy one with the touchscreen on it. And maybe that's a good thing. Could fear of a recession actually cause a recession?
Well, it can, in the sense that when you think about an economy that is at least 2/3 consumer spending, 70%, you need people to spend. You need people to feel comfortable spending. And what is happening now is people see the inflation outlook combined with all of these fears of recession, a stock market that's really in turmoil. We're down about 500 or 600 points as we speak right now on Wall Street. People see all of this and they're like, maybe I can't spend that much, or what I thought I needed, maybe I don't need, or maybe I need to wait. And then the worst part of it is if people look out into the future and believe that prices aren't going to normalize to some extent, they may, in fact, be more inclined to pull back on spending. So you want to pull back or cooling in the economy, which is what the Fed is trying to engineer. But again, because the economy is so reliant on consumer spending, you need people to get out and actually spend. And if they don't, then we're talking about layoffs. And then we're talking about a lot of retrenchment in the economy that does, again, you leap from the fear to the reality of a recession.
But so where do we stand on consumer spending? Because it does feel like in some of the indicators that we look at, for example, travel, that people are hitting the road in record numbers. People are still buying televisions. People are still buying refrigerators. The housing market in New York City, for example, just to use one example, is out of control. And so you can't have high housing prices without people that are willing to pay those prices. So help us understand this sort of juxtaposition between consumer spending and where we are right now with inflation and these recession outlooks.
You know, we're getting a lot of mixed data, and the data suggests that the economy is still performing at a very high level, albeit not as strongly as it was maybe several months ago. But you're correct in the fact that consumer spending has remained afloat. People just keep buying their way through this inflationary cycle that we're in. I think you mentioned at the other segment about revenge travel. People are very much, the crowded airports are testament to the fact that people are getting out, they're spending, they want to do more with experiences and travel as opposed to buying the television or the car. They kind of been there and done that. And a lot of us that were working from home and then went back into the office or the studios or whatever, we kind of refreshed our wardrobe. We've done those sorts of things. Now everyone's like, okay, I want to go to Tulum. I want to go to abroad. I want to go, now that international travel restrictions have been lifted. So they're spending a lot on that. So there's a bit of a pullback on some of these other goods and services that in the economy that we'd seen that were traditionally strong, but none of that yet points to recession. Now, the National Bureau of Economic Research, they're the sort of official arbiters of recession. They look at certain criteria that's a little bit different than a lot of these real-time economic indicators that we look at. And one of those is the unemployment rate. And unemployment, the jobs market, extremely strong right now.
So the question, of course, becomes then when people are they spending because they've been able to save over the course of the last 3 years and receive also in some instances money from the government? And once that happens, once you have dipped into all that money that you saved, do we get back to a situation where we have a negative savings rate in the United States, or people are putting more of these purchases on their credit cards?
Well, the pandemic was really good for household balance sheets. People were able to save because they weren't really going anywhere. But also what you have now is, people are still, that whole effect of wanting to get out and wanting to go out, I think is a lot of ways just driving or keeping the economy afloat. And people, I think the disposable income has been eaten up a lot by inflation. So people have gotten raises,
that's a good point.
but the soaring prices have not kept pace with those raises that they've gotten.
So let me ask you about what the Fed is doing, right? Because as they say, there aren't many options. It's a blunt instrument, raising interest rates. But I also thought to myself, it's not just raising interest rates. It's also the messaging that comes out of the Fed. We hang on every word that the chairman says, right, to indicate what might be coming in the future. So I want to get your take on not only the raising of the interest rates, but also the suggestion that other raises may be coming down, down in the future, and whether or not that's having the desired effect.
Well, that cuts to the core of what I was just talking about, which in terms of inflation expectations. The Fed is very concerned, not necessarily about what's going on now, but what consumers think might happen in the future. And they're trying to sort of corral that and pull that back in and bring it back to earth. And right now, because people can't necessarily see the end of the rainbow or the end of the road, they're very nervous. And again, the sort of the current fear that we're fearing now has a lot to do with people's uncertainty and the market's uncertainty about the future. And that uncertainty is really unpredictable. It can lead the market to do crazy things, and we're seeing that now. It can lead consumers to say, I don't want to spend this money. Maybe I don't need this vacation. Maybe I don't need this car. Maybe I don't need this TV or whatever it is that I was thinking about buying, especially if I think it's going to be more expensive.
Yeah, it is really fascinating. It's because so much of it is emotional. We think it's all about numbers on a piece of paper, and so much of it is
especially
emotional.
When it comes to consumers. I mean, it's a completely different scenario. When looking at the stock market, you mentioned, Javier, the stock market is down today. I don't know if we have the big board up, but the reality is that when I talk to my old colleagues, because I used to work on Wall Street, institutional people who are institutional buyers and sellers, asset management, they're seeing this as a golden opportunity to dig into some of the companies that they really love. Whereas consumers, because we react by emotion, you see the market going down, you call your broker and you say, I need to get out, I need some safety. And that
or if you're a retail trader, there are a lot of retail people trading on their own. They just sort of hit the button on their own.
That's right.
And are they influencing these wild swings that we need? Because I always thought that the stock market was sort of dominated by these institutional investors, and that's what's causing this.
But the institutional players play with the money that is in consumer, in other words, these 401ks, these are big pension funds that are managed by an institutional asset manager, but underlying those assets are me and you.
Right, and we're freaking out a little.
Right, exactly. Really interesting. Great to have you here in studio, Javier. Please come back, because it'd be nice to have you every day. Not every day, but when you because every day I'm going to talk about the market every day.
I got work to do, but yes, to the extent that you want me back, I'll come back.
We love it. Thanks, Javier. Appreciate it.